Welcome to the Commercial Real Estate Show. Thanks for joining us to lead, learn, and laugh. Learn market knowledge and best practices to lead your company's success. And that's whatever type of your company you're working with. And laugh, I believe we have to have some fun along the way, right? Well, hello, I'm Michael Bull, your host to the world of commercial real estate. Thanks for being with us today. If you have any questions or comments about today's show or about any commercial real estate related endeavors, we do enjoy hearing from you. You're invited to connect with us, follow, like, tweet, circle, email, or call us. All our contact information and social media connections are available at the show website, commercialrealestateshow.com. Today our show is called The Fed's View on Commercial Real Estate. We have the opportunity to talk with Brian Bailey, the Senior Financial Policy Analyst in the Supervision and Regulation Division of the Federal Reserve Bank of Atlanta. Brian has had an impressive career in the industry, including time with Ernst & Young, Flagler Development, and Tavistock Group. Brian has earned the CCIM designation and an MBA with concentrations in real estate and finance from the University of Florida. Brian Bailey, welcome to the Commercial Real Estate Show.
Michael, thank you for having me. Grateful to be here. Welcome the opportunity to present some information to your audience today. Thank you.
Well, great. Well, we appreciate it. And the first thing I'd like to start with is, what is the mission of the Fed related to commercial real estate, and what is your role there?
Absolutely. The Fed has three primary functions: monetary policy, which includes the dual mandate of full employment and price stability or inflation control. Second, safety and soundness. The Fed is one of the primary bank regulators, so we're heavily engaged in the safety and soundness of the financial system, as well as making sure that laws are complied with. Mm-hmm. And then the third is we have a large payment system which is involved in the check and electronic payments, as well as a significant cash processing operation.
Okay. And how are they lucky to have someone involved in commercial real estate with your background, and what is your role there?
My role is as Senior Financial Policy Analyst in commercial real estate. I follow commercial real estate for the Fed, and that has primarily two elements. One is providing our bank examiners with a sounding board for commercial real estate valuation and commercial real estate questions as they're in the banks looking at institutions as far as safety and soundness and whether they've complied with the laws and regulations. Secondly, I provide thought leadership throughout the system on commercial real estate issues.
Okay, so you're tracking commercial real estate in a very big way for the Fed.
Absolutely.
Okay. And well, just how much and how does the Fed monitor commercial real estate? What tools do you use, and what do you do every day to track it?
Well, the Fed rigorously monitors commercial real estate for two primary reasons. First, the banks currently have about $1.4 trillion worth of CRE loans outstanding on their books today. As the slide shows, and we've put some slides up with Michael's permission on his website, it shows that the balances in multifamily and the other CRE portion, which represents leased properties, have hit all-time highs in the last 6 years. So certainly we need to rigorously continue to monitor those situations. Secondly, commercial real estate is a huge, important piece of our national economy.
It's more important than people think, isn't it?
Absolutely. I've seen a couple of studies from NAIOP, which is the Commercial Real Estate Development Association, that said in 2010, roughly $230 billion was spent on development and tenant improvement projects, and in 2011 that number was closer to $260 billion.
And that was a down year.
Absolutely, absolutely. So it has a huge impact on the economy.
Yeah. And banks are a big part of commercial real estate. If banks are lending, commercial real estate can move forward, the tenants can get loans. So how are banks faring now, and have they turned the corner?
Generally speaking, as a whole, we've seen financial conditions improve in the banking sector. As evidence, I would reference the slackening rate in the number of institutions that's declined. We're seeing improvements in the economy. The commercial real estate and residential real estate sectors are seeing the number of delinquent mortgages drop. So certainly some positive news as far as the financial health of the institutions. However, there are still some institutions that remain challenged.
Yeah, and they've become quite profitable again, though, right? Banks are doing well. Their second quarter numbers were strong, and overall the banking industry is doing a lot better, isn't it?
Certainly there were some good results in this last quarter, but as far as profitability is concerned, I mean, that is highly dictated by the bank's business model, their knowledge base as far as their products are concerned, as well as their appetite for risk. So I can't really speak about profitability. I can say that the Federal Reserve is heavily engaged in the safety and soundness and regulation of those institutions.
Okay, and how does the Fed do that? How do they help banks remain profitable and safe for everyone?
Well, we've got a number of internal and external data sources that we tap. Additionally, we're very close to the primary drivers of commercial real estate. For instance, unemployment, banking and finance trends, retail sales, rail traffic, just to name a few. So certainly we're heavily engaged in monitoring those, but we have to take it a step further. We've got to engage the marketplace and talk to knowledgeable market participants about what they're seeing day in and day out. So we kind of have, a convergence of what the marketplace is seeing as well as what the data is telling us. And then we take that and rigorously analyze it to make sure that the trends that we're seeing are correct.
Well, that's smart, because if you just look at the past, sometimes you don't know what's coming in the future, right?
Absolutely.
And it's those industry participants, like listeners to this show, that can kind of give you an idea what's coming down the pike. Well, how will lenders look at commercial real estate moving forward, Brian?
Great question. And really, I sit in a bank regulator's position, so I can't speak to how lenders view real estate at this time.
But they've got to have certain levels of commercial real estate loans that are below certain levels. And I know some banks seem to be aggressively out there looking for loans, and some maybe not so much too. So they're regulated by how much commercial real estate loans they can have, right?
Well, we certainly have some guidelines that we've prescribed to them that certainly influence our regulation processes. But really, a lot of that, as we talked about, is driven by their business model, their knowledge, their product knowledge, locational knowledge of the loan itself, as well as their appetite for risk.
Yeah. Well, I think it's interesting. More lenders have learned through this downturn, I think, that if you're lending in your backyard, maybe know a little bit more about it.
Absolutely.
And the properties and the borrowers, and maybe that's a little safer. Well, what other advice would you give to banks related to commercial real estate right now? I'm interested in your view there, because in my view, this is one of the safest times that banks can do commercial real estate loans in my 30-year career, because we're at the beginning of a recovery, and everyone seems to be acting a little safer with their money. What kind of advice do you have for banks?
Absolutely. There's certainly some lessons we've learned, but I believe that we're in the midst of a very unique part of the business cycle. For instance, we have interest rates that are relatively low, which have driven down cap rates, hence property values have increased. Secondly, interest rates are low, which has lessened the debt service requirements. And third, we're in an improving economic recovery. And typically, you don't have those three factors converge for a very long period of time.
Yeah.
So certainly, I think that we've got to be, the marketplace has to be mindful of the convergence of those three. Commercial real estate is a capital-intensive business. At points, the banks have done a very good job at meeting this need and turning a profit. In my opinion, in the future, banks will have to have active management, well-disciplined, rigorous capital, and good underwriting standards, as well as locational knowledge, to make sure that they can meet the future needs correctly.
Well, those are good tips. I think they've got to be a little more careful than they had in the past. But again, I think it's such a great time in the economy and in the recovery to be doing loans. Well, stay tuned for more of the Fed's view on commercial real estate. I'm Michael Bull. This is the Commercial Real Estate Show. We'll be right back. The Commercial Real Estate Show is brought to you in part by your friends at Bull Realty. When your business requires proven performance, visit bullrealty.com or call 800-408-BULL. Welcome back. I'm Michael Bull, and this is the Commercial Real Estate Show. If you'd like to know the absolute latest on any commercial real estate related topics, check out our on-demand show podcasts. Some available topics include social media for business, loan workout strategies, zoning for dollars, and I like this one, oops, should have covered that in the lease, and lease versus purchase analysis at this point in the cycle. Basically, if I think it's interesting, we've covered it. Well, you can access the shows anytime on your smartphone, tablet, or computer. Just visit iTunes or the show website, commercialrealestateshow.com. Today our show is called The Fed's View on Commercial Real Estate. We're talking with Brian Bailey, Senior Financial Policy Analyst with the Federal Reserve Bank of Atlanta. And Brian, I'd like to ask your view on CMBS at this point in the cycle. How is that CMBS going right now?
Absolutely. The CMBS market has improved significantly over where it was in the downturn. I mean, we're seeing improved issuance volumes. We're seeing less delinquencies, so certainly some positive improvements there. I think that last year the issuance volume was roughly $45 billion. I think through August the volume is close to $55 billion, so we've already surpassed the numbers last year. Secondly, on average, we're seeing less CMBS loans become delinquent. So roughly right now, on average, there are about 160 loans a month that are becoming delinquent, which roughly represents $2.1 billion, compared to last year where there were over 220 loans a month becoming delinquent, and the numbers that represented about $3.3 billion per month. So certainly we're seeing some improvements in delinquencies. We're seeing participants come back to the marketplace. So more participants certainly is good for the marketplace. However, as you're well aware of, there are those vintages that were done in 2005, 6, and 7, the loans that were done when property values were at a different place in the stratosphere. And so as the 10-year clock rapidly approaches on some of those vintages, it certainly presents a possible headwind in the marketplace that we need to remain aware of. Additionally, a number of those loans used some form of interest-only structure. And so there's not been a significant amount of amortization in a number of them. As reference, about 80% of the 2007 loans, of the loans made in 2007, used an interest-only structure.
So we still may have a little distress coming down the pike.
A headwind.
Headwind, I like that. Okay. Well, what advice can you share with listeners, Brian, who may be out looking for a loan for their commercial real estate right now?
Absolutely. I think conditions have improved, and that certainly is good news. As evidence, I would reference the slide that we put up about the balances that are growing at banks right now in commercial real estate, particularly multifamily, and in the other CRE category, which represents lease space. So good news there. The other thing I'd reference is a loan officer survey done by the Federal Reserve. And we've seen underwriters respond to that, loan officers respond to that, and tell us that they are loosening underwriting standards. So certainly some good news there. However, it's not all a rosy picture. I mean, the riskiest loans, the construction and development, the C&D loans, still remain an issue. We are seeing some banks that are beginning to stick their toe back in the water and re-engage on some of those fronts, but certainly, they're very interested in taking measured risk. Okay.
And the real estate market is obviously affected by the job market. And, what do you expect for job growth, and how might employment growth affect commercial real estate either way?
Absolutely. Big impact. Mm-hmm. From 2008 through 2010, the economy shed roughly 9 million jobs. To date, We've created about 7 million, give or take. So we're roughly 2 million jobs short.
I'm glad I'm still working here at the show.
Absolutely. So, if you use a loose number of 150,000 jobs created a month, we should be back to peak 2007 employment numbers sometime around the end of the year. So certainly the economy is, been moving forward since 2010. So some good news there. I don't have a crystal ball as far as my expectations on unemployment.
We have one back here. We'll let you look at
I
it.
need to borrow it, yes. Absolutely. But, I think that some of the job growth has been muted to date because of the uncertainty surrounding the downturn, as well as some of the new regulations that have come out, because certainly it's taken, some resources on the part of business owners to get their hands around what those new regulations and what the uncertainty and the cost associated with some of that looks like. And so certainly that's muted in some instances some of the employment growth. But my expectation is that, as it becomes more of a known item, that we will continue to see, barring any kind of unforeseen event, we'll see job growth continue to move forward.
Yeah, and there's some markets too that are seeing more job growth, right? I mean, this recovery is really segmented toward different areas of the country, and what do you see there?
Absolutely, and we've posted some slides to give the viewers some good firsthand knowledge of what we're seeing in the contiguous 48 states. But if you look at job growth, I mean, take for instance North Dakota right now. We're seeing the eastern half, which is seeing a significant job growth decline, but the western half of the state has seen some of the highest job growth rates in the country, because of the new technology surrounding oil, the oil shale there, et cetera. So certainly, a little bit of a dichotomy. We're seeing a mixed bag, I guess, per se. Some areas are doing well. Some of those areas I'd reference are some of the hardest hit areas in commercial real estate. If you look at California, if you look at Florida, Georgia, even Las Vegas, I mean, those areas were hit very hard in commercial and residential, and we now see job growth in almost all of them. So I think it's really telling the story that the economy is moving forward. It's progressing on a positive track, but again, as we've heard at many levels, it's not hitting on all cylinders.
Yeah, and I've lost money in Vegas too, but I've also come back. I think I'm ahead out there.
I only go there to speak.
Well, what do you expect for GDP and imports and exports? There's been some talk of manufacturing coming back to the U.S. What do you expect there, and how might that affect commercial real estate?
You bet. Great question. And certainly great news from when we had Thursday, where GDP came in at 2.5%. I think the market viewed it very positively. So again, we're moving on the right track. We're improving. Imports and exports, a little bit of a mixed bag. Several of our export partners, our largest export partners, are in the midst of recession. I'll reference Europe, our European folks. So certainly kind of a mixed bag there. As far as expectations per se, the Atlanta Fed, as well as the Federal Reserve Board of Governors, post their expectations on the website. Again, my personal view is that we'll continue to see GDP grow over time, barring any kind of unforeseen event.
Okay, well, that's good news. Well, we're going to post these slides on the website, so if you're not driving and you want to see these, go to commercialrealestateshow.com and look for shows on demand and check the Fed's view on commercial real estate. And then also, if you're watching the video, well, you're already seeing them. Well, stay tuned for more of the Fed's view on commercial real estate. I'm Michael Bull, and this is the Commercial Real Estate Show. We'll be right back. The Commercial Real Estate Show is brought to you in part by France Media. France Media provides exposure to the world of commercial real estate. Visit francemediainc.com or call 404-832-8262. Welcome back. I'm Michael Bull, and this is the Commercial Real Estate Show. You may be listening to the show today anywhere from Orlando to Hawaii. The show's been broadcast around the world for close to 3 years on iTunes and multiple websites, and is aired on 12 stations across the country. We'd like to welcome our listeners in Albuquerque, New Mexico. Today our show is called The Fed's View on Commercial Real Estate. We're talking with Brian Bailey, Senior Financial Policy Analyst with the Federal Reserve Bank of Atlanta. And Brian, this recovery has been a little long, a little slow. How does this recovery compare to past recoveries, and how might that affect real estate?
Absolutely. Great question, Michael. Mm-hmm. We went and looked at the last two recoveries. Mm-hmm. So coming out of the recession in 2002 that ended in 2003, and looked at job growth over the 39-month period there, and then contrasted that with the last downturn and beginning in 2010, how job growth looked for that 39-month period. And we classified the jobs into 13 different categories, but 3 of them stood out as significant, night and day from the 2 recoveries. First is manufacturing, and you talked about a manufacturing recovery. This really proves it. So in 2003, beginning in that recovery, we actually lost an additional 339,000 jobs, lost. In this recovery, we've actually gained 510,000 new jobs.
Wow.
So certainly, seeing some positive, aspects from manufacturing. But construction, which is near and dear to commercial real estate and residential, is a different story. So last time in 2003, we created almost 1 million construction jobs in the 39-month recovery period. This time, we've created only 250,000, and most of those jobs have been created in the last 12 months. Mm-hmm. My guess is a lot of them are to do with the multifamily construction. So certainly, very interesting to kind of see the differences in the recovery. And then the final category is government. Mm-hmm. So federal, state, municipal. Last time, there were 600,000 jobs, give or take, that were created in 2003 and the 39 months prior. This time, we've continued to shed jobs in those areas, and we've shed almost 660,000 jobs. Got this slide, given the slide to Michael, so he'll probably put it up on the website if it piques your curiosity.
Yeah, we'll have it there for sure. And so that's manufacturing, so that's good news for the industrial market, which has been showing some signs of improvement.
Absolutely.
Well, Brian, how do you see retail sales and retail real estate faring in the next few years? And, we have online sales that are affecting it. We have consumer confidence issues. And where is consumer confidence? What do you see for retail real estate moving forward?
Right. Well, certainly we've seen some good signs in consumer confidence in the last few months. Both the Consumer Confidence Board as well as the index done by the University of Michigan have shown all-time highs since 2008.
And my wife and daughter have shown real confidence as well.
So have mine. So certainly we're seeing some positive dynamics there. And as you know, retail sales are very kind of niche specific. It's a very broad category. There's certain luxury categories that have barely even felt the downturn. So, but certainly, their retail sales is huge to the overall economy, and we have to continue to watch it. I think as far as online sales are concerned, we're seeing, it continues to grow. It certainly is presenting some challenges to traditional retailers. As evidence, I would say that you've seen, a number of the big box retailers that have shrunk their footprints over time. So we certainly see it. So, potential there. But let's speak about the consumer real quick and just talk about kind of what's driving them right now. I mean, they come out of the downturn. There's still a significant number of folks that their skill sets are mismatched with what employers are looking for. Interest rates, have moved in the upward direction in the last 120 days. So certainly if you're looking to buy a home or have, in the process, that cost is going up. But certainly there are other costs other changes and costs that could present headwinds over time. and certainly it bears watching because you're not seeing income grow significantly from the consumer's perspective. And that's one of the slides that we've put on the website is, it shows income growth by county. And so you see a kind of mixed bag of counties that have positive as well as negative income growth over the last year. But interesting, to kind of give you a mental picture, there's a swath down the middle of the U.S. that runs from Texas to North Dakota, and a significant number of counties are growing. Income is growing for folks in those counties. But as you move toward the coast, it becomes more of a mixed bag. Yeah. And the overall average for the U.S. is down 0.1%.
Wow. Okay. Well, stay tuned for more on the Fed's view on commercial real estate. I'm Michael Bull. This is the Commercial Real Estate Show. We'll be right back. The Commercial Real Estate Show is brought to you in part by your friends at Bull Realty. When your business requires proven performance, visit bullrealty.com or call 800-408-BULL. Welcome back. I'm Michael Bull, and this is the Commercial Real Estate Show. We have some great shows coming up for you, including a show next week on tax credits, and the following week, a show on office tenant strategies. Be sure to catch shows of special interest to you. Sign up for a once-a-week email announcing the show topic at commercialrealestateshow.com. Well, today our show is called The Fed's View on Commercial Real Estate. We have Brian Bailey, Senior Financial Policy Analyst with the Federal Reserve Bank of Atlanta, here in Studio One. And Brian, I'd like to ask you about the overall economy. And what do you expect moving forward there, and how do you expect the economy moving forward to affect commercial real estate?
Absolutely. Great question. I think that we'll continue to see strengthening in the economy over the next few years. However, the Federal Reserve and the Federal Reserve Bank of Atlanta certainly post our expectations on our website of what those numbers will actually look like. As far as commercial real estate, we are beginning to see some vibrancy. Some real trends are developing from a national perspective. We've seen all the vacancy rates move down over the last few quarters. Even retail, which was considered kind of the languishing sector over time, is beginning to show some real movement. So certainly some very positive developments in commercial real estate. We're factoring those with changing use preferences in space. So, for instance, you talked about online sales, and we're seeing, a move away from the traditional bricks and mortar retailer, small move, but we're seeing, a corresponding increase in the use of industrial space and need for industrial space. So certainly some good movements there. Take office space. We've seen a number of tenants that are, downsizing or right-sizing the amount of space that they're using. At the same point, they're putting more folks into that space, and so your square footage per employee, is certainly you're getting more efficiency out of that. But that certainly also brings up different questions from a landlord's perspective.
Well, Brian, what do you expect to see for interest rates moving forward? Interest rates, everyone expects them to rise, and and how might that affect commercial real estate?
Absolutely, and a question on a lot of people's minds. Yeah. However, I don't have a crystal ball.
I told you I've got one right here.
Right, absolutely. There are many inputs that go into interest rate policy. And I'd reference a speech given by the president of the Atlanta Federal Reserve, Dennis Lockhart, in August. Basically, President Lockhart said that keeping short-term interest rates near zero for a considerable amount of time after asset purchases end will help maintain a high degree of monetary policy accommodation. Very low interest rates will continue for a while. The FOMC's guidance, Federal Open Market Committee, which decides interest rates, their guidance on policy rate is that it'll stay near zero for at least as long as the unemployment rate stays above 6.5%. So generally speaking, commercial real estate benefits from a low interest rate environment, and the Fed has kind of communicated our expectations on short-term rates for the foreseeable future.
Yeah, I certainly agree. I mean, low interest rates have really saved a lot of our clients with their properties, and and also the lack of new construction. There's been very little new construction, and that's helped commercial real estate a lot. That's for sure. Well, what about quantitative easing? How is that affecting the economy, and how might that affect commercial real estate?
From my perspective, the large-scale asset purchases, or as the public knows this policy as quantitative easing, or QE, these purchases have been intended to put downward pressure on long-term interest rates and raise the prices of financial and other assets, and one of those being commercial real estate. QE has impacted the marketplace, by lowering cap rates, which has increased values. So certainly, some very good news for commercial real estate. As a byproduct of lower debt and higher values, the CRE marketplace needs to take notice now that we've introduced the subject of tapering. Certainly, it will bring about changing market conditions as this policy, has changes on the overall economy.
Right, that's a good point, and those changes are good. I mean, the economy is improving, commercial real estate's improving, so tapering seems to make sense.
Absolutely, and I mean, one of the things that I'd bring up in one of our slides is cap rates, and so certainly, quantitative easing has pushed down, the risk-free rate, which is the rate in the 10-year, which a lot of real estate investors use as the risk-free rate component of cap rates, and so certainly, as that begins to move up, then the probability of cap rates moves up as it rises grows. And I think, my personal opinion is that we'll see that dynamic more in assets that aren't in quite as high demand. There's still a significant amount of capital that's chasing, core deals or suburban, high quality deals and multifamily assets.
Yeah, and now a little bit more into the secondary markets. You're right.
Correct.
Well, stay tuned for more of the Fed's view on commercial real estate. I'm Michael Bull. This is the Commercial Real Estate Show. We'll be right back. The Commercial Real Estate Show is brought to you in part by France Media. France Media provides exposure to the world of commercial real estate. Visit francemediainc.com or call 404-832-8262. Welcome back. I'm Michael Bull, and this is the Commercial Real Estate Show. Today, our show is called The Fed's View on Commercial Real Estate. We're talking with Brian Bailey, Senior Financial Policy Analyst with the Federal Reserve Bank of Atlanta. And Brian, I'd like to get your opinion on Obamacare and how might Obamacare affect jobs and commercial real estate moving forward.
Absolutely. And a great topic. It's one on the minds of a lot of business owners as I've gone out and met with them and discussed commercial real estate and how that looks in how it affects their business plans. So really a lot of anecdotal evidence. But these business owners have predominantly had the opinion that the President's healthcare initiative has added additional uncertainty to a marketplace where there's already been some uncertainty. So, and they've talked about, the amount of resources that they need to use and have used in order to understand, what the ramifications are under that legislation. And so, they've been concerned about it. And I think in a lot of ways, they've told me that it has delayed hiring decisions because they couldn't fully understand quickly, their obligations and costs under that. So, and as you know, if enough owners feel that way, certainly it'll slow hiring decisions, which could impact, the fundamentals of demand in commercial real estate. However, offset from that is we're seeing improving fundamentals in the commercial real estate markets. Demand is up in retail, office, multifamily, and industrial. So, there are some positives there, but again, as I like to say, a little bit of a potential headwind.
Yeah, potential headwind, a little bit. Yeah, it's interesting if people who run companies are making hiring decisions feel a little uncomfortable. Typically, they won't grow and they won't hire. So, well, let's talk about the Fed. But as we finish the show here, what might surprise people about the Fed?
Absolutely. Well, first of all, the Fed is not funded by the federal government. Certainly something that I wasn't fully aware of. Mm-hmm. And we charge for the services that we provide to the financial institutions. We also get income from the investments that we've made on the balance sheet. And so last year, we made a profit of roughly $89 billion that was turned over to the U.S. Treasury. So certainly, we provide services and make a profit, and it gets turned over to the Treasury. Secondly, being involved in the bank regulation process, I was not aware of the skills and the amount of intense work that is required to examine a bank. So very fascinating there. And additionally, since we've come through a time where the banks, a lot of banks have had challenges, and they've felt the need to use the appeals process, and I learned a lot about the appeals process and how it's geared to ensure fair and unbiased treatment.
Yeah. Okay. Well, those are interesting points, and I like that profit. Thank you very much.
Absolutely. Absolutely.
And we're short on the end of the show here, but you guys are tracking real estate, I think, a lot more than people have realized possibly. What do you think about possible overbuilding in the multifamily area?
It's a dynamic that could happen to any commercial real estate segment. Mm-hmm. Multifamily has benefited significantly in that, really the fundamentals were softening even prior to the downturn. So in 2006 and 2007, multifamily fundamentals were softening, and so it makes sense that it would be the first segment out of the downturn. It's also been positively impacted by the low amount of construction coming in 2009 and 2010, as well as foreclosures and the lack of financing has all contributed, as well as the number of jobs that were predominantly geared toward the 20 to 34-year-old crowd.
Ron Bailey, thanks for joining us today. We appreciate it.
Thank you very much.
Thank you. If I have a question for you as a listener, can you join us next week? We'll be talking about tax credits. I'm Michael Bull. Until next week, be sure that you always lead, learn, and laugh, and join us for the Commercial Real Estate Show. The Commercial Real Estate Show is brought to you by your friends at Bull Realty, France Medio, Atlanta Office Liquidators, and Wiseman, Nowak, Curry, and Wilco. For more information about these companies or to access additional show podcasts, videos, or blogs, visit commercialrealestateshow.com.